Talking about this volatility, how are you advising your clients to manage the volatility that we're seeing in the market right now?
Well, you know what? We're telling our clients to stay calm. Remember what Warren Buffett always said? Be fearful when everyone's greedy and be greedy when everyone is fearful. Well, when the volatility hits, it's time to look out for opportunities. We've played the outperformance trade of the US versus Europe, the US versus Asia. But I think as China and Asia valuations start getting very interesting and very appealing, it's probably time to relook that and begin to start sharpening your pencils to start investing in China. Go back to China. Start looking out for great value and good entry levels. Everyone was talking about how they missed the last rally. Well, Chinese banks with the recent RRR and credit easing and regulatory easing will stand to benefit, right? And the Chinese banks are giving very decent dividend yields right now. Chinese insurance companies are doing well operationally. And when you have a bad day in China big tech, why not have a look? If you missed the last rally, not a bad time to start looking again.
Could you be underpricing risk, given that, there are some suggestions that the trade war will not erupt the way it could be, it could erupt, but the thing is, it could go the other way as well.
Yes. So, as Jody just said, there's a lot of political rhetoric going on right now, which, I don't think you can accurately predict. But looking at all the policies that's come out of China, the long-term structural changes, the tilt to consumption growth, and the tilt to technology, I think, the Chinese government's been doing a lot of the right long-term things to put the economy back to growth. And they've suffered the short-term volatility. They've suffered all the rhetoric, and as we believe, you should be looking when things are bad, and not you should be looking to buy when things are bad. This is as good a time to start looking as any.
Susanna, it's Rish in Hong Kong. You mentioned the banks here. This is a sector, Chinese banks has always been an industry group which has screamed value. You look at PEs, they're really cheap. You look at dividends, they're pretty good. You're looking at return on equity. You're looking at tier one capital ratios. And they all have a buy signal, and they have done for ages, but nobody seems to really like them that much. Why do you like them?
Well, I think, they've suffered from the whole disintermediation of the big tech in China. You've had, WeChat and Ant Financial really in the last 3 to 5 years taking market share and disintermediating the big banks in China. But I think we're going to see that balance of power tilt now as regulators come back and they realize, oops, we need to start regulating the technology companies that are doing financial services, A, to even out the playing field, B, to really tighten the tap, and C, we think that whole P2P boom which has happened and created, frankly, a rather sort of difficult and dubious shadow banking market is starting to come to roost, and people are realizing, oops, maybe that should have been regulated as well. So I think as the regulations tighten and change, and the banks, as you said so yourself, are fundamentally pretty strong, and the regulations will probably be in their favor, it's not a bad time to start looking.
Talking about regulations, we have to touch on compliance issues. Right now, bankers are pretty much grappling with the issue of having their bankers use platforms which are not monitored. How are you ensuring that DBS bankers do not come into, complications when it comes to compliance?
It's a great question, Haslinda, and I think you can't fight the social media boom, so you have to join it, but you have to join it in a way that is regulatorily compliant and also safe for your customers to use. So we're launching this FinChat platform, a wealth chat platform, which enables our customers to opt in to using social media to communicate with their bankers, their advisors in a compliant way. Everything is recorded, everything is logged, and so if you have transmission of instructions or ideas or frankly just asking questions, it's all recorded.
Approved by the regulator.
Well, every regulator has different standards, so we have to approach everyone differently. But yes, it has to be regulated, it has to be compliant, and that's where we're going.
Sushan, David here in Hong Kong. We had a story last week, and let me just ask you about the business here, and I'm sure a lot of our viewers and clients are interested in this next question. A lot of the private bankers are getting just crazy pay hikes by jumping ship. I'm just wondering, because of so little supply servicing too many crazy rich Asians, can I expect a massive pay hike if I move to DBS?
Okay, that's a good question too. I think supply-demand dynamics will, the markets are free and it will correct in terms of supply increasing. At DBS, what we have done is we've built our bench. We've built our bench either through hiring younger staff and training them across the wealth continuum. We start them off at the retail side, and we move them up to priority banking. We get them to do the exams, and then they train them, and they become eventually private bankers. Or we've also looked at hiring sort of mid-level careers, people who are in finance but in a different role. They could be in corporate banking, they could be investment banking, they could have been in asset management, they could have been working in the oil and gas sector, in finance, for example. People in their 40s, potentially in their 50s, but looking for a career switch. I think, having this barbell approach where you build your bench from the younger staff, and then you bring in mid-career people who are experienced, battle-tested, but perhaps not quite trained yet in private banking, but we convert them into product specialists and eventually into private bankers as well. I think you can, fill this gap. So I don't believe that every bank needs to join in this, crazy rush for talent. I think that customers will not move their assets as quickly as some private banks might hope they will, because, at the end of the day, you stay with the bank that's here for the long term, that's committed.